If you were to ask almost anyone right now to picture the future of the global economy, their mind is probably going to immediately jump to a very specific set of images.
Oh, absolutely. They think of the cloud.
Right, exactly. You picture the cloud, you picture artificial intelligence, algorithms, weightless data just floating seamlessly through the ether.
Yeah, sleek Silicon Valley campuses, coders in those expensive ergonomic chairs.
Exactly. This entirely digital, almost invisible revolution that is supposedly going to fundamentally alter how you live, how you work, and definitely how you invest.
And it all feels incredibly intangible, doesn't it?
It really does. But what if I told you that to truly understand the future of cutting-edge AI, to actually grasp the sheer physical scale of the digital economy, you don't need to look at a software company at all.
Right.
What if, to see the future, you actually need to look at a 100-year-old heavy machinery and diesel engine company?
I mean, it is the ultimate paradox of the modern age. We've been sold this idea of a weightless economy for, over a decade now?
Oh, easily a decade.
But the reality, the absolute physical truth of the matter is that the cloud is incredibly heavy.
Yeah.
I mean, the cloud is made of steel, it's made of copper wire, it's made of concrete, and it requires just staggering, mind-bending amounts of electricity to actually function.
Which brings us directly to our mission for this deep dive. Today, we've got a stack of source material centered around one very specific, highly revealing document.
And it's a fascinating one.
It really is. It's the Q2 2026 earnings call transcript from Cummins Inc. They trade under the ticker symbol CMI.
Right. The engine guys.
Exactly. And our goal today is to look right past all that standard Wall Street jargon. We are going to uncover how global infrastructure, complex supply chains, looming emission regulations, and the absolute explosion of the data center boom are physically manifesting in the financial results of a true industrial titan.
And looking over the notes we've gathered for this, I just have to say the sheer scale of the global economy that gets casually discussed in a single hour-long corporate phone call is eye-opening.
It's wild. You pull one thread on this earnings call, and suddenly you're analyzing the physical limitations of the electrical grid in Texas.
Yeah, and then you pull another thread, and you are dissecting the mechanics of mining equipment exports into Africa, or, the psychology behind regulatory pre-buying in North America.
Yeah, it's just a sprawling story. But before we get into the why and the how of all those moving parts, we really need to establish the baseline for you.
We need to look at the headline numbers.
Right. And for the second quarter of 2026, the financial scale here is genuinely hard to wrap your head around.
It's substantial by literally any metric. I mean, let's just start with the top line. In Q2 2026, Cummins delivered record second quarter sales of $9.5 billion.
Wait, $9.5 billion in a single quarter?
In a single quarter. To give that some immediate context for you, that is a 9% increase compared to the second quarter of 2025.
Wow.
Yeah, so when you extrapolate that out, you are looking at a company operating at a nearly $10 billion quarterly run rate, or, approaching $40 billion annually.
That is just a massive volume of physical product. I mean, engines, generators, axles, filtration systems, just constantly moving through the global supply chain.
It's difficult to overstate.
Yeah.
And importantly, it wasn't just top-line revenue that hit a record. Their EBITDA came in at a record $1.7 billion for the quarter.
Okay, and for anyone who might be newer to reading earnings transcripts, EBITDA earnings before interest, taxes, depreciation, and amortization, that's essentially a measure of core operational profitability, right?
Precisely. It strips out all the accounting quirks and basically just asks, is the actual business of making and selling engines generating cash?
Right, before the accountants step in.
Exactly. It's the purest look at how effectively they turn raw steel and labor into profit before you calculate depreciation and taxes. And clearly, they are doing it very efficiently.
But where it gets really interesting to me is the cash flow.
Oh, the operating cash flow was huge.
Yeah, it hit a second quarter record of $1.5 billion. That is up significantly from $785 million just a year ago.
They nearly doubled their operating cash flow year over year.
Which is insane for a legacy manufacturer. And management noted on the call that this was driven primarily by improved working capital.
Right.
Okay, but Let's stop right there, because working capital is one of those classic Wall Street phrases that gets thrown around on every single earnings call, and I think a lot of people just kind of let it wash over them.
Oh, for sure. It sounds like generic corporate speak.
Exactly. So what does it actually mean for a heavy industrial company like Cummins to improve their working capital to the tune of nearly $1 billion?
Well, it's a crucial concept if you're trying to understand the actual health of a manufacturing business. So think of working capital as the cash that is currently trapped inside the plumbing of the business.
Okay, trapped how?
So if Cummins builds 1,000 engines, right, but those engines are just sitting in a warehouse, that is capital tied up in inventory.
Yeah.
It's cash they can't use.
Right, it's just sitting there as metal.
Exactly. Or if they ship those engines to a truck manufacturer, but that manufacturer has 60 days to pay the invoice, that is capital tied up in accounts receivable.
Ah, I see. So the money is owed, but it's not in their bank account yet.
Right. So improving working capital simply means they got more efficient at unclogging that plumbing.
Got it.
They're moving inventory out the door faster, they're collecting the money owed to them faster, or conversely, they're negotiating longer times to pay their own suppliers.
So when a company the size of Cummins improves that efficiency by even like a few percentage points, it shakes hundreds of millions of dollars of cash loose.
Exactly. They essentially sped up the metabolism of the business.
And when a company suddenly has a record $1.5 billion in cash just sloshing around, they have a choice to make, right? They have to allocate it somewhere.
And Cummins made it very clear where a big chunk of that cash is going, right back to the shareholders.
Yeah, I saw that. They returned $501 million to shareholders in this quarter alone.
That's a massive payout.
It really is. It was split between $225 million in share repurchases and $276 million in cash dividends. And this is a data point that really stuck out to me. Management highlighted that this represents their 17th straight year of dividend growth.
It's a remarkable streak, honestly. CFO Mark Smith pointed out on the call that this aligns with their long-standing commitment to returning approximately 50% of operating cash flow to shareholders.
17 years. I mean, if you think about what has happened in the global economy over the last 17 years.
Right. The 2008 financial crisis.
The pandemic.
Massive supply chain shocks.
Multiple changes in presidential administrations. Maintaining and growing a dividend through all of that is exactly what institutional investors are looking for.
It projects a deep underlying stability in an industrial market that is historically known for being highly cyclical and, frankly, pretty volatile.
Okay, but let's unpack this for a second, because this is where we had a really strange contradiction in the numbers. I'm looking at this margin squeeze paradox.
Ah, yes, the margin drop.
Right, because we just established that they had record sales. We established they had record EBITDA in terms of pure dollars hitting $1.7 billion. But if you look closely at the actual percentage, the EBITDA margin dropped.
It did. It went down to 17.5% of sales compared to 18.4% a year ago.
So if I'm an investor, I'm scratching my head. How does a company make more money than ever before, but their profit margin percentage actually shrinks? Like, are their costs spiraling out of control?
It's the exact right question to ask, and it is precisely what equity analysts zeroed in on during the Q&A portion of the call.
Because normally that's a huge red flag, right?
Oh, a shrinking margin in an industrial company is often a canary in the coal mine. It can indicate that raw material costs like steel or aluminum are skyrocketing. Or it can mean that they're losing pricing power and having to offer steep discounts just to move their inventory.
But that's not what's happening here.
Not at all. The underlying mechanics of this specific margin drop are completely different. Management explained that a small portion of this drop was driven by global tariffs, which is, just the reality of doing business internationally right now.
Sure.
However, the primary driver for the shrinking margin percentage was higher variable compensation expenses.
Wait, let me make sure I'm doing the math right here. Their profit margin percentage shrank because they had to pay their own employees more bonuses.
That is exactly what happened.
And they had to pay those bonuses because the company is projecting record full-year earnings.
Yes.
That sounds like literally the best possible problem a company can have.
It really is.
I mean, it's like owning a sports franchise. Imagine you own a baseball team, and at the start of the year, you budget a certain amount for player salaries and standard bonuses.
Right, you have a baseline expectation.
Exactly. But then your team goes on this absolute tear. They win the World Series. Your star players hit 60 home runs. They shatter every single internal performance metric you set for them.
And because of their contracts, you now owe all your players massive championship bonuses.
Right. So your profit margin for that specific fourth quarter might look terrible on paper because of the sudden payout, but as an owner, you're thrilled because the underlying performance that triggered those bonuses means your franchise value just skyrocketed.
That is a perfect way to visualize it.
Yeah.
And, if you are trying to be a smart observer of business, this teaches a critical lesson. You cannot just look at the top line percentage.
You have to dig deeper.
You always have to investigate the mechanism behind the shift. A margin drop caused by performance bonuses, directly tied to record-breaking revenue growth, is fundamentally different from a margin drop caused by, say, out-of-control labor strikes or a sudden spike in the cost of copper.
Totally different scenario.
Furthermore, we really need to talk about the accounting mechanics here. CFO Mark Smith specifically clarified that this top-up in incentive compensation created a lump of noise in the second quarter earnings.
Noise? What do you mean by noise in this context?
Well, in corporate accounting, you have something called an accrual. You don't just wait until December 31st to see if you hit your targets and then suddenly write a massive check for bonuses.
Right, you'd want to plan for that.
Exactly. You accrue for it, meaning you estimate the bonus payout at the beginning of the year and set aside a little bit of money every month on the balance sheet. It's basically an internal IOU.
Okay, makes sense.
But halfway through the year, Cummins realized they were going to absolutely crush their original estimates. So they had to raise their full year financial outlook.
Oh, I see where this is going.
Yeah, when they raise the outlook, the accounting rules require them to immediately true up those bonus IOUs to match the new higher expectation.
So they had to take all of that extra expense and just jam it into the second quarter?
Precisely. They essentially had to play catch up on their own success all at once.
Wow. Okay, so the margin squeeze isn't a systemic operational flaw at all. It is largely a one-time accounting catch-up reflecting their own upgraded guidance.
Exactly. And Smith noted that because they took that big catch-up hit in Q2, the run rate for this expense will actually normalize in the second half of the year. He expects that expense to drop by about $25 million per quarter heading into Q3 and Q4.
That completely flips the model upside down. So the core business is incredibly healthy. Top line revenue is up 9% overall. But, if the overall U.S. trucking market isn't exactly in a massive boom cycle right now, how did they get that 9% growth?
That is the big question.
Right, because when you look inside the segment breakdowns, there is one specific area that is absolutely catching fire. And it ties directly back to our opening thought about the physical reality of the cloud.
Yes. We need to talk about their power generation business.
We certainly do, because this is where the macroeconomic narrative physically intersects with Cummins' manufacturing lines. The power systems segment saw its revenues hit a record $2.3 billion in the quarter.
And unlike the overall company margin we just discussed, the EBITDA margins for this specific segment jumped significantly, moving from 22.8% a year ago to a very robust 24.5%.
That's a huge jump for a division that big.
It is. North America power generation revenues increased by 19%. But the data point that truly stops you in your tracks is China.
Oh, yeah. I couldn't believe this number.
Sales of power generation equipment in China skyrocketed by an astounding 88% in the second quarter.
88%. I mean, you just do not see heavy industrial equipment sales nearly double year over year in a major market unless something fundamental in the world has tilted on its axis.
It's unheard of.
Right. Like you might see an 88% jump in a software as a service company adding new subscribers, but to see it in massive multi-ton metal generators, what is the physical mechanism driving that?
Well, the management team was entirely explicit about what is driving it. It's accelerating data center demand. Yes. The artificial intelligence boom is physically pulling diesel and natural gas generators out of Cummins factories as fast as the workers can assemble them. In fact, they cannot assemble them fast enough to meet the demand curve.
That was one of the craziest parts of the call.
During the Q&A portion, an analyst asked about the current lead times for the massive 95-liter generator sets. The response from management was one of the most revealing moments of the entire transcript.
What did they say?
They stated that if a customer wants to place an order for one of these high-capacity generators today, they're going to have to wait until the second half of 2028 for delivery.
Wait, 2028? We're talking about a backlog that stretches out over 2 full years.
Correct. And this highlights a critical physical bottleneck in the global economy that often goes completely ignored.
How so?
Well, when you read headlines about major tech companies announcing new multi-billion-dollar AI data centers, the immediate assumption is that the primary challenge is securing the latest microchips. You assume the bottleneck is the silicon, right?
Sure, everyone is talking about getting enough GPUs.
Exactly. But what this earnings call reveals is that the secondary and increasingly primary bottleneck is securing the physical infrastructure required to power and cool those chips.
Because the math is brutal. If you cannot secure industrial scale tower generation, you cannot turn on the data center. It literally does not matter how many chips you have.
Exactly. The exponential growth of the digital economy is currently being physically constrained by the manufacturing capacity of heavy industrial companies like Cummins.
And Cummins management is clearly leaning into this. I mean, on the call, CEO Jennifer Rumsey highlighted two massive game-changing deals that perfectly illustrate how they're positioning themselves as sort of the toll booth for this mega trend.
The first one was huge.
Yeah, first she mentioned a multi-year agreement with what she called a global hyperscaler. Now, in industry parlance, a hyperscaler is one of the giant cloud computing oligopolies, like a Microsoft and Amazon Web Services or Google.
Right, the big players.
And this agreement secures visibility into several gigawatts of future backup power generator set demand. Now, the transcript doesn't explicitly translate what a gigawatt means in this context, but we really need to put that into perspective for the listener.
We do, because it is easy to let a word like gigawatt just sound like generic sci-fi jargon, like Back to the Future.
Exactly, 1.21 gigawatts. But to ground this in physical reality, one single gigawatt of electricity is roughly the generation capacity of two average-sized coal-fired power plants.
Right. It is enough electricity to power roughly 750,000 average homes.
And Cummins just signed an agreement to provide several gigawatts of localized power for a single corporate customer. It is an almost unfathomable concentration of physical power generation.
It really is. But as large as that deal is, the second agreement Jennifer Rumsey mentioned might actually be more significant from a long-term strategic standpoint.
Oh, let's get into it. This is the Thursday Energy deal, right?
Yes. She discussed a June agreement with a company called Thursday Energy down in Texas. Under this agreement, Cummins is providing QSK-60 and HSK-78 natural gas generator sets, along with integrated microgrid technology to support a high-performance computing data center.
Okay, but here is the critical mechanical distinction that blew my mind. This equipment is not being installed for backup power. This is a behind-the-meter prime power solution.
It is a complete paradigm shift.
I want to stop and dig into the mechanics of this because I think a lot of us use words like generator and power interchangeably. Can you clarify exactly what the difference is between backup power and prime power in the context of a data center? Because it sounds like Cummins is fundamentally shifting what their equipment is actually doing.
They absolutely are. Historically, the relationship between a data center and a generator company was basically an insurance policy.
Okay.
The primary source of electricity for the data center is the local municipal utility grid. You plug the billion-dollar server farm into the public grid, just like you plug a refrigerator into your kitchen wall.
Right.
And Cummins would sell the data center massive diesel generator sets to just sit outside the building. If a storm hits or a transformer blows and the local utility grid fails, the Cummins diesel generators spin up within seconds to prevent the servers from crashing and losing data. That is backup power.
Right. So those engines sit completely idle 99% of the time, just waiting for an emergency. They're essentially emergency parachutes.
Exactly. But the Thursday Energy deal in Texas represents prime power. And the mechanics of why this is necessary are just fascinating.
Tell me.
The sheer energy density required by modern high-performance computing, specifically the servers running continuous artificial intelligence training models, is so immense that in many regions, the local utility grids physically cannot handle the load.
The grid just isn't built for it.
Right. The grid cannot provide the necessary megawatts fast enough without risking brownouts for the surrounding community. And upgrading the public transmission lines and building new public substations can take a decade of regulatory approvals and construction.
And these AI companies do not have a decade to wait.
Exactly. So they are essentially saying, we can't wait for the utility company. We're going to generate our own primary electricity on site.
Meaning, Cummins isn't the backup parachute anymore. They are the main engine of the airplane.
Precisely. They are using Cummins natural gas generators to provide the primary continuous source of electricity. The generators are running constantly, 24/7.
Wow.
And they are sitting behind the meter, which is a crucial term. It means the electricity being generated never interacts with the public utility grid.
Yeah.
It doesn't pass through a municipal meter. It goes straight from the combustion chamber of the Cummins natural gas engine directly into the cooling systems and servers of the data center.
Think about the implications of that for a second. If you are an entrepreneur right now, and you are trying to build the next great AI startup, your mental model is probably focused entirely on software.
Naturally.
You think your biggest hurdle is going to be optimizing code or raising venture capital or poaching the best engineers from Google.
Right.
But if you actually want to scale, your physical bottleneck is figuring out how to continuously combust enough natural gas on site in rural Texas to generate the megawatts required to keep your server racks from physically melting down.
It completely shifts where the leverage is in the tech industry.
It really does. Cummins is suddenly sitting as a physical gatekeeper to the AI revolution.
And management understands that this isn't just a temporary blip, It is a long-term structural shift in how power is consumed. To capture more of this market, they actually announced on the call that they are expanding the development of a brand new 130-liter natural gas generator set.
A 130-liter engine, that is massive.
They are engineering entirely new, massive combustion engines specifically designed to extend their reach into this growing prime power market.
So if you are holding stock in an AI ETF right now, you're probably heavily focused on semiconductor chips and software algorithms. But what this Cummins data proves is that you should probably be just as focused on copper wire, thermal management, and heavy industrial combustion engines.
Absolutely.
Yeah.
The new economy is entirely dependent on the old economy being able to forge the physical tools of localized power generation.
That is the exact actionable takeaway here. However, as explosive as the data center story is, we cannot let it completely overshadow the rest of the business.
Right, because Cummins is still fundamentally a heavy machinery company.
Exactly. The core of their identity, and honestly the bulk of their historical revenue, comes from building engines for heavy-duty trucks, medium-duty delivery vehicles, excavators, global mining equipment.
The legacy business.
Yeah. So if we pivot away from the cloud for a moment, how did their traditional legacy highway business actually perform in the second quarter?
Well, let's look at the North American trucking market first, because the numbers here tell a really interesting story about market dominance.
Right, because the overall industry wasn't doing great.
Exactly. If you just look at the overall industry, the production for heavy-duty trucks in North America was actually down in the second quarter. The industry as a whole produced 60,000 units, which represents a 4% decrease from the same period in 2025.
So it's a shrinking pie.
It is. But within that shrinking market, Cummins heavy-duty unit sales were 23,000. That is actually an increase of 2% year over year.
That is wild. That is the definition of market share capture in a down cycle.
Exactly.
But mechanically, how does a legacy company manage to grow their sales when the overall market they are selling into is contracting?
It comes down to a few structural advantages that take decades to build. In the heavy-duty truck market, fleet managers are not just buying an engine right. They are buying uptime.
Because if a long-haul truck breaks down, that fleet is losing money by the hour.
Exactly. Cummins has spent a century building out a sprawling, continent-wide dealership and service network. When the overall market gets tight, fleet operators tend to consolidate their purchasing toward the supplier that offers the most reliable, widespread maintenance support.
That makes total sense. You retreat to safety and reliability when the market softens.
And additionally, Cummins has deeply entrenched long-term supply contracts with the major truck OEMs' original equipment manufacturers. So even if total truck orders drop, Cummins engines might be disproportionately represented in the trucks that are being built due to these structural agreements.
Okay, but what about the medium-duty sector? You'd think heavy-duty trucks are the whole story. But the medium-duty sector, your local delivery box trucks, your municipal vehicles, that is often a much better indicator of local last-mile economic health. Did they see the same dynamic there?
The medium-duty side was actually much stronger across the board.
Really?
Yeah. The overall industry production for medium-duty trucks in North America was 32,000 units, which was an increase of 8% from 2025.
Okay, so the market grew.
It did. But once again, Cummins aggressively outpaced the broader industry. Their medium-duty unit sales were 29,000, which represents a massive 19% jump year over year.
Wow, 19%.
And to add another layer to their North American dominance, they noted that they shipped 33,000 engines to Stellantis, specifically for use in Ram pickup trucks during the quarter.
Oh, wow.
So the North American highway business, despite a slight contraction in heavy-duty industry production, is proving to be an incredibly robust cash engine for them.
But as solid as North America is, the global numbers are where this transcript turns into a real-time map of geopolitical trade. We talked about the 88% jump in China's power generation earlier, but if the U.S. heavy-duty market is shrinking slightly, they must be making up ground somewhere else.
They absolutely are.
Are they offsetting this internationally with their traditional truck and construction markets?
Yes, and China was a powerhouse across all segments in Q2. Total revenues in China, inclusive of their joint ventures, hit $2.3 billion.
That's huge.
It is a 30% increase year over year. Industry demand for medium and heavy-duty trucks in China specifically was up 24%.
Okay, but here is where we have to look past the top-line number and really examine the mechanics of global trade. Management noted that this 24% increase was not solely driven by domestic Chinese consumption.
Right. A significant portion of this demand was driven by exports.
Yeah. Chinese truck manufacturers are building vehicles powered by Cummins engines and exporting them in large numbers to emerging markets, specifically Africa and Southeast Asia.
See, that is the ripple effect of global commerce. A trucking company in Kenya or Vietnam needs to expand its fleet. They place an order with a Chinese manufacturer, and a Cummins joint venture factory in China ramps up production.
Exactly. And I saw in the notes that the excavator numbers in China followed a similar heavily export-driven pattern.
Yes, the heavy construction equipment side was even more pronounced. Industry demand for excavators in China jumped 34%, and the Cummins units sold into that market were up 35%.
But again, the why is the crucial part.
Right. Management pointed out that this surge was heavily driven by export demand for global mining investments, specifically highlighting projects in Indonesia and Africa.
So if I'm tracking this correctly, a new mining project gets greenlit in Indonesia, perhaps to extract nickel for the global electric vehicle battery supply chain, right?
Very likely.
So to dig that mine, they need heavy excavators. They buy those excavators from China, and those excavators are powered by Cummins diesel engines. It is an incredibly complex supply chain.
It is. And there is one more detail regarding the Middle East that truly highlights how sensitive this supply chain is to risk. Management noted that their results in this segment also benefited from OEM inventory stocking designed to mitigate potential logistics risks in the Middle East.
Explain the mechanics of that. Why does a logistics risk in the Middle East cause a jump in sales for a factory in China?
It is entirely based on the psychology of supply chain management. If you are an original equipment manufacturer, your worst nightmare is having a half-finished truck sitting on an assembly line because you are missing one vital component, like an engine.
Right, it stops everything.
When these OEMs look at the geopolitical tensions or shipping lane disruptions in the Middle East, like issues in the Red Sea, they calculate the risk of their engine shipments being delayed.
Oh, I see.
To mitigate that risk, they engage in defensive inventory stocking. They order extra engines now, intentionally hoarding them in their warehouses just in case a shipping lane gets blocked next month.
So it is artificial demand driven by fear of disruption, but for Cummins, an order is an order, and it drives revenue up in the current quarter.
Exactly.
It is genuinely fascinating to see human psychology, fear, and risk mitigation show up as a hard percentage increase on a quarterly balance sheet.
Yeah.
And briefly, looking at the rest of Asia, I noticed India also posted solid numbers.
Yes, India remains a very steady pillar of growth. Cummins reported second quarter revenues in India of $742 million, which represents a solid 6% increase.
What's driving that?
Management attributed this to increased freight availability, ongoing domestic infrastructure development, and continued mining activity.
If you step back and synthesize all of this, the truck exports to Africa, the mining equipment going to Indonesia, the defensive stocking in the Middle East, the infrastructure build-out in India, reading a Cummins earnings transcript is genuinely like reading the vital signs of the global physical economy.
It really is. If you want to know who is physically building, who is extracting resources, and who is bracing for supply chain shocks, you don't necessarily need to read academic economic papers. You just look at where the diesel engines are shipping in any given quarter.
It's the physical truth of global commerce. Okay, so we've established that the current truck market is solid, they're dominating market share in North America, and global trade dynamics are keeping the international factories humming. But we really need to pivot because there is a massive storm cloud, or perhaps a massive moat, depending on how you analyze it, looming on the horizon for the North American trucking industry.
Yes. The EPA 2027 regulations.
We have to talk about the impending regulatory cliff. How exactly is management communicating their strategy for navigating this transition?
This is arguably the most critical transition period the heavy-duty engine industry has faced in decades. For context, The Environmental Protection Agency recently released a proposed rule that provides the final clarity on the implementation of the new, highly stringent on-highway 2027 emissions regulations for North America.
And these demand massive reductions, right?
Huge, massive reductions in nitrogen oxide and particulate matter. In response, Cummins announced what they are strategically calling a measured transition, utilizing the specific implementation flexibilities that the EPA outlined in the rule.
Okay.
To meet these standards, Cummins is bringing an entirely new generation of engine architectures to market, which they have branded the Helm engine platforms.
But wait, introducing an entirely new, highly complex engine architecture across an entire continent's freight network all at once seems incredibly risky. How does this measured transition actually play out on the calendar? Are they just flipping a switch on January 1st, 2027?
No, because flipping a switch would invite chaos. The timeline is deliberately staggered to mitigate risk for both Cummins and the fleets. According to CEO Jennifer Rumsey, they plan to begin limited production of the new model year 2027 X15 engine in January of 2027.
Limited production.
Right. This initial rollout will be carefully coordinated with the individual truck manufacturers' launch plans. Production of the new X15 will then ramp up progressively, with full volume production not expected until the fourth quarter of 2027.
Okay, so slow ramp.
Similarly, for their smaller X10 engine, limited production starts in January 2027, with full production expected by the third quarter. But here is the crucial mechanical detail that the EPA flexibilities allow.
What's that?
During this entire transition year, Cummins' current legacy engines, specifically the X12 and the L9 used in vocational trucks and transit buses, are expected to remain available for purchase.
Interesting.
Furthermore, their current V platform engines will remain available for all of 2027, with the next generation V platform not launching until January of 2028.
Okay, I want to dive into why they are doing this, because historically, when new, highly restrictive EPA rules hit the trucking industry, it completely distorts the market. It creates what the industry refers to as a pre-buy cliff.
Exactly. The pre-buy cliff is a textbook example of regulation inadvertently causing severe market volatility.
It's like hoarding toilet paper before a lockdown.
Pretty much.
Fleet managers look at the upcoming regulations and they run the math. They know the new compliant engines are going to be significantly more expensive because of all the new emissions technology. But more importantly, they are terrified of beta testing new tech.
Oh, absolutely. If a brand new engine architecture has a software bug or a sensor failure in its first year, that truck is stuck in a repair bay and the fleet is bleeding money.
So to avoid the higher costs and the reliability risk, fleets panic buy massive amounts of the old trusted legacy trucks the year before the regulation takes effect.
Which creates an artificial massive spike in sales.
Right. But then, the year the regulation actually hits, the fleets have completely exhausted their capital budgets and they refuse to buy the new trucks. The market falls off an absolute cliff, factories sit idle, workers get laid off, and it's a brutal economic cycle driven entirely by regulatory avoidance.
That is exactly how it has played out historically.
Yeah.
But by utilizing these EPA flexibilities, staggering the launch of the Helm platforms, and explicitly keeping the legacy engines available for a transition period, Cummins is actively attempting to smooth out that boom and bust cycle.
They're giving fleets a pressure release valve.
Right. A fleet can slowly dip its toes into the new Helm technology with a few trucks, while still having the safety net of purchasing the older, proven tech they trust for the bulk of their operations.
But this brings up a massive question that an analyst actually asked during the Q&A. The analyst asked about the financial realities of selling those older, non-compliant products in 2027. And CFO Mark Smith brought up something called NCPs. Wait, if I'm a fleet manager, I'm doing the math here. Am I actually going to willingly pay a government penalty just to avoid buying a new engine? Is that what an NCP is?
Yes, NCP stands for non-conforming penalty. It is a specific mechanism built into the EPA framework. Essentially, if an engine does not meet the strict new 2027 emission standards, it can still legally be sold during this flexibility window. But it incurs a financial penalty assessed by the government.
And who pays that?
Mark Smith was very direct on the call. Cummins expects to pass those penalty costs entirely onto the market, meaning the buyer pays the fine and the purchase price. So to answer your question, yes, a fleet manager will sit down with a spreadsheet and run a very complex calculation. They will weigh the higher upfront purchase cost and the potential early-stage maintenance downtime of the new 2027 compliant engine against the known reliability of the legacy engine, plus the added cost of the government penalty.
And Cummins thinks they'll pay it.
Cummins fully expects that many fleets will choose to pay the penalty. They will view it as an acceptable insurance premium for peace of mind, while the new tech proves itself in the real world.
That is an incredible look into the psychology of industrial purchasing. You have pricing power, technology trust, operational risk, and regulatory penalties all swirling together in a single decision by a logistics manager.
It is extremely complex, and it's an important impartiality check for you, the listener. Regardless of where you stand on the political spectrum regarding environmental regulations, climate change, or EPA mandates, we have to analyze this purely through the lens of business mechanics.
Right, no politics, just the numbers.
Exactly. Regulations definitively drive up research and development costs, and they create immense logistical and manufacturing hurdles for companies like Cummins. They have to spend billions engineering these compliant platforms.
However, from a pure business strategy perspective, Cummins also views these new, highly engineered powertrains as the largest driver of increased value for the vehicle moving forward.
Precisely.
But how so? Doesn't the regulation just commoditize the engine further? Like, everyone has to meet the same standard?
Quite the opposite, actually. Because the engineering barriers to entry to meet the 2027 standards are so phenomenally high, the companies that can successfully clear that hurdle gain massive pricing power.
Oh, because no one else can do it.
Right. Jennifer Rumsey explicitly stated that the industry expects the powertrain to be the largest contributor to the increased value and price of the trucks in 2027. If you are a new startup, you cannot just quickly engineer a heavy-duty diesel engine that meets EPA 2027 standards.
It's impossible.
The regulation is a massive hurdle, but successfully clearing it creates a deep, wide moat around Cummins' core business.
And speaking of clearing massive technological hurdles, we should briefly touch on Accelera, which is their specific zero emissions segment. This is the division focusing on electrified powertrains, hydrogen fuel cells, and electrolyzers. Is this segment just burning cash, or are they making real progress?
Accelera is a much smaller piece of the overall revenue pie right now, but it is a crucial window into their long-term transition strategy. Accelera revenues increased 38% to $145 million in the quarter.
Okay, that's decent growth.
It is. But more importantly for investors, their operational losses actually shrank from $100 million a year ago down to $69 million in this quarter.
Narrowing losses. Management attributed this to targeted cost reductions and the benefits of scaling up production, I assume.
Yes, exactly. So the mechanical reality is that they are aggressively growing the top line of their future zero emissions tech while simultaneously implementing operational discipline to rein in the R&D losses. They are trying to bridge the gap between the diesel present and the electrified future.
Okay, we have covered a massive amount of ground. We know exactly how they performed in Q2. They generated record cash. They are capitalizing on massive data center demand in ways most people don't realize. They're navigating a complex web of global supply chain psychology, and they are charting a very deliberate, staggered course through the upcoming EPA 2027 regulations.
It's a full plate.
It is. But the market is forward-looking. Where is management steering the ship for the rest of 2026? Let's look at their forward guidance.
The guidance portion of an earnings call is always the most heavily scrutinized section because it tells you what the executive team actually believes about the macroeconomic future, not just what they achieved in the rearview mirror.
Right, what's coming next?
And the tone from Cummins management across the board was one of immense, broad-based confidence. They essentially raised their full-year guidance across almost every single major financial and operational metric.
Okay, walk us through the specific upgrades. What are the numbers?
Originally, they expected total company revenues for the year to increase in the range of 8 to 11%. They have officially upgraded that expectation to a 10 to 13% increase. They also raised their overall EBITDA margin guidance for the year to a range of 18 to 18.5%, which signals they expect strong profitability despite that Q2 bonus payout noise we discussed earlier.
And what I found interesting is that they didn't just raise the vague financial metrics, they actually raised guidance on the physical movement of goods, right?
Yes, they updated the physical volume forecasts. They raised their forecast for North American heavy-duty truck industry production to a range of 240,000 to 250,000 units. They raised the medium-duty truck forecast to 130,000 to 140,000 units. Looking internationally, they upgraded their China revenue expectation to an approximately 15% increase for the year.
Wow, across the board.
They even upgraded global construction demand from a previous expectation of negative to flat, all the way up to flat to up 10%. It is virtually a clean sweep of upgrades across their end markets.
So Synthesizing all of this, what is the actual state of the company? It sounds like they're firing on all cylinders, to use an appropriate pun.
Very appropriate. If we synthesize the tone of the entire call, it is a unique mix of immense macroeconomic confidence paired with severe operational strain.
Strain? How so?
Well, they are raising guidance because the demand from their customers is practically locked in. The orders are there.
Why so?
But the pressure on their internal supply chain teams, their factory floor managers, and their raw material sourcing, especially in the power system segment, building those massive generators, is immense.
Oh, because they're sold out to 2028.
Exactly. As we discussed, they physically cannot build the equipment fast enough to satiate the AI boom. The challenge for Cummins right now is not finding customers. The challenge is physically forging the metal, securing the thousands of subcomponents, and rapidly expanding global manufacturing capacity without degrading the reliability of the engines.
It is a high-class problem to have, but a deeply complex operational challenge.
Definitely.
And just to tie a bow on the financial mechanics, CFO Mark Smith provided a really clear tailwind note for the rest of the year regarding those profit margins. Because they took the heavy incentive compensation hit in Q2 to true up for these upgraded record projections, that expense is going to normalize.
Right. As we mentioned earlier, it will drop by about $25 million per quarter.
Which means those already strong EBITDA margins have a built-in accounting tailwind heading into the third and fourth quarters.
Exactly. The financial accounting mechanics are aligning beautifully with the physical demand in the market.
All right, let's do a final recap of the actionable bottom line for you, the listener. What we learned from dissecting the Cummins Q2 2026 earnings call is that this is a company exhibiting immense pricing power and structural market share dominance in their legacy heavy-duty trucking business, even in a slightly contracting U.S. market.
True.
We learned that they have executed a highly strategic, wildly successful pivot to position themselves as the physical, mechanical power brokers of the AI and data center revolution. And we learned that they are taking a very deliberate, staggered approach to smooth out the historical boom and bust cycle of EPA regulatory shifts, even if it means passing penalty costs onto their buyers.
And that comprehensive picture leads me to a final provocative thought for you to mull over as you look at your own portfolios or evaluate the broader economy.
Let's hear it.
We are constantly inundated with the narrative that software is eating the world. We are told by venture capitalists and tech CEOs that the future economy is weightless, that it is entirely digital, and that all value will eventually live exclusively in the cloud.
That's the dominant narrative for sure.
But based on the physical constraints we have unpacked in this deep dive into Cummins, we have to ask a difficult question. Is the exact opposite actually true?
Wow. Are we entering an era where the absolute most valuable, most indispensable companies on Earth won't necessarily be the ones writing the smartest code, but rather the heavy industrial titans?
Exactly.
The legacy companies that can actually forge the steel, build the physical grid infrastructure, and continuously combust the massive amounts of prime power required to keep the digital lights from flickering out.
It is a profound shift in leverage. The cloud may feel ethereal, but its existence is entirely bottlenecked by iron, copper, and fire.
That is the question to take with you today. Keep questioning the physical realities behind your digital screens. Keep looking for the mechanical truths in the balance sheets, and we will catch you on the next deep dive.